Hello, I'd like to welcome everybody to the November 1st Town Hall for the All Financial Group. You got me and Mel here going to be doing that today. And I just want to thank everybody that's here in person. And I want to thank those that are going to listen to it later. We really appreciate that. If there's anybody that you think could be benefit from this, please don't hesitate to forward the email that you are going to receive later or the link to the town hall for tonight. And I'm going to go ahead and turn the first part of this town hall over to Mr. Mel.
All right, thank you. Again, appreciate you joining us today, and hopefully, I know a lot of people do watch this on the recording, and quite honestly, it does get recorded and eventually put up on our YouTube channel. So if you want to refer your friends or neighbors to that, you can tell them to look All Financial Group up on YouTube, and we have quite a few of our back issues. My subject today is going to be concerning annuities, believe it or not. I know that just surprises the heck out of some of you, but I found a really great article that came out of Kiplinger, and I got a quick copy of here, and I just did some highlighting on it. And if you guys would like copy of this, we'd be happy to forward it to you. We recommend Kiplinger is a great service if you'd like to subscribe to them on financial issues. But in this particular one, it's talking about how to find a fixed indexed annuity that works for you. And it starts out really great. No two annuities are the same, and fixed indexed annuities have absolutely exploded in popularity. I've personally been associated with the sale and promotion of fixed index annuities since the mid-90s. They originally came on the market in the United States in 1995. The first one was put out by Sun America, and it was an excellent product and has progressed over time and gained in popularity. And today, a modern fixed index annuity doesn't look a whole lot like the original versions we had back in the late 90s or even the early 2000s. And there's a lot of different variety of choice in the matter. And I like a lot of the things that they said here in Kiplinger. It said basically today, people are living off Social Security and our pensions, and things are a whole lot different today. I know that the record-breaking sales in 2022 of fixed index annuities over $310 billion. Now, that's not necessarily a large sum compared to the total invested dollars, but that's a huge sum compared to what was 5, 10, 15 years ago when it comes to how much money was placed into fixed index annuities. It's really important here. In addition to not being able to rely on their pensions and Social Security today for meeting all their income needs, we have longer lifespans in retirement. Today's generation might spend 20 to 30 years in retirement, where before it might have been 10 or 15 years for the average life expectancy. Plus, we actually today face a more volatile market than maybe we have in the past. A great example here is in huge downturns in the market in 2000, 2002, 2008, 2020, 2022. These were 30 plus points fall in the overall market. And to make it even worse, bonds had a particularly bad year in 2022 because of the rising interest rates. So our normal haven that was supposed to protect us from equity exposure in the downturn, it went down too. So there was a bit of a systemic loss across the board. We saw that coming for a lot of our clients and moved a great number of or percentage of their bond portfolios over into some short-term fixed index annuities to protect the assets. And it worked very well. Now that the bond market has settled down and gotten back into play, we're moving those monies back into more invested structures. When it comes to annuities today, there's a lot to learn. There's basically a couple of different types. One would be looking for the accounts that are grow based on, okay, let me back up. The term fixed indexed annuity has three different terms associated with it. Fixed, meaning that the principal is generally protected from the exposure to downturns in the market. Indexed, indicating that your return of gains is based on an index of some kind. It could be commodities, it could be gold, it could be the S&P 500, it could be other types of indices out there that are even a combination of them that are it's just amazing. There's literally hundreds and hundreds of them that are available. So picking something to tie your wagon to as far as the upside, can really make a difference in which index you want and what kind of performance you might actually end up getting. Often, FI accounts are they mirror the actual index, like the S&P 500. And even when you're not getting the full performance, there are durations you have to worry about. Do I need a 3-year, a 5-year, a 7-year, or a 10 years? Is this a short-term thing or a longer thing that I have to be considering to protecting my principal? But this is a really interesting case that they put in here. If I had $100,000 and I needed $5,000 a year out of it, and I invested it in the market versus using a fixed indexed annuity, that's what this example is all about. In this example, they literally run it where a pretty low participation rate. What they're saying is that if you put your money in the market and you have no limit on your earnings, you also have no limit on the downward spiral that the market might take. Whereas if you use the fixed indexed annuity, you have the floor of not losing your principal, but you still participate in the upside. In this case, they're only getting 40% of what the S&P 500. Now, today you can get a lot better participation rates and much higher caps. But in this example, they're saying if you had a 100,000 with a 40% participation in the S&P or the S&P itself, at the end of this time period, with the straight S&P, you would have had $33,402 left out of your 100,000. But with the FIA, fixed index annuity, you would have had $57,575. So same index, different methodology, same starting amount, same income value, more money left at the end of the time period. And that is the point. You may not get all of the upside, but missing the downs has a lot of power in making your money last. And especially when you're pulling income out. When you're in the accumulation mode and putting money away for retirement, ups and downs, you want to invest regularly ups and down because you're buying shares at a discounted price. But when you're spending the money out of that pot, it's very difficult to take money out when your assets are depreciated, and it will affect the overall longevity of that particular money. And this is a really good example of how that might work. Again, that's just an example. When it comes to using FIAs, there's a couple of ways you can do it. You can do it for accumulation, where I primarily just want to protect the principal and grow it as much as possible, and I don't really care about having a guaranteed income stream. Another way to do it is with the exact same structure, I can add something called a living benefit rider. I still enjoy the protection on the principal and the upside when things are going well, but I also have an income stream that will be guaranteed at some future date. Now, there's variations on that theme. You can have some of them that will give you large percentage bonuses to start out and a fixed growth rate over a period of time and flat out guarantee a payout stream at some future date, or the performance of the index, whichever is better. And some of them don't perform very well, and the living benefit will be your income. Others have a really great history at performance and might actually outperform the guarantee. The real trick to this, and the whole point of this particular article, is you want to make sure that you're working with a professional and understanding that avoiding the sequence of risk returns or large losses at the beginning of your retirement can be really, really devastating. You have to be careful, because when you're buying living benefits or riders, you have to be aware that there may be fees involved for that particular structure. There's just a ton of information to know about that. No two annuities are the same, so while shopping for an annuity, keep these things in mind. The important features for you to be aware of: duration, participation rates, and caps. How long is the surrender charge period? And during that period, do I have access to some of the money, or is it all locked up? In most cases, the annuities today give you the ability to have withdrawals of a certain percentage of the money on an annual basis without a penalty. So it's not like you have to park your money and leave it around for 5 or 10 years. You can access it for income if you needed to. Then you have to be aware that some kind of limitation on the upside is probably going to be involved. It could be that it is a participation rate. But with today's indexes and the types of options trading that are used to back some of these index annuities, you may actually get a multiplier of what the index would do. Some of the carriers will pay you 100% to 150% participation on a 1-year product, but then may on a 2-year give you a 2 to 250%. On a multi-option product, it could be 3-4 times whatever the index does over a period of time would be added to your account. I know I'm throwing a lot of numbers and concepts here at you, but I need you to understand that yes, there's a limit, but sometimes there's actually a bump in values depending on the type of structures you're using. Caps today are considerably higher. You might have today, there's quite a few products that will give us a 12% cap or ceiling on an S&P product. Now, it varies by contract and company, but I can name at least 4 or 5 today, and that might not be true tomorrow, that have a cap of 12% and a floor of 0, and there's no fee involved. You don't pay an annual percentage out of your gains, nor do you pay an advisory fee for managing it, nor do you pay any participation fees. So it's simple and straightforward. Whatever the S&P does on an annual basis between 0 and 12 is yours. If it's -2, you get a 0. If it's 14, you get a 12 in that example. Now, other indexes may have, and other products may have 10% caps with other features, or even lower caps with bonuses. So which is better? Which is the right one for you? Is it participation rate? Is it caps? Or maybe is it a mix? Maybe it is the multi-option, the multi-strategy type products. Am I just looking to accumulate the money and decide what I want to do with it in the future? Do I want to have a guaranteed income stream in the future? Am I looking to pass it on to my heirs, and I would like a leveraged or bonused value to go to my heirs if I don't use the money myself? There's 3 completely different concepts, and you need to choose the appropriate product for the concept. So it goes back to something that I've said for a very long time. If you're going to build a house, you don't start by picking out the saws and hammers. You design a plan, you get a blueprint, you build out what it is, what your purpose is, what you're trying to end up with, and then you backtrack into the appropriate tools to get that job done. When Steve and I sit down with someone to put a plan together, we don't start looking at product immediately or which investments. We start looking at what their goals are, what their income streams are. We put a plan together for income, for tax efficiency, for legacy, for long-term care. All of those things are part of that planning process. Once we have an idea of what our ultimate objective is, then we can go back and start picking out which tools. Is it life insurance, annuities, assets under management, structured notes, stock portfolios, dividend portfolios? All of those things may be a part of the mix, but first you got to know where you're going. And that's a big part of the process. If you're looking to add annuities to your overall financial plan, make sure you work with a knowledgeable, independent financial advisor. Now, I should have double-lined independent, because one of the advantages that we bring is being an independent. We have the ability to offer just about any insurance product or annuity out there on the fixed index side, and we currently work with probably 40 or 50 different companies. But when some new company comes along, or a company comes along with a new product and it's the best choice, we'll go get that one too. Our objective is to find out what you need, what's best for you, and then go get that product, not to promote any particular company or product structure. So I went through that rather quickly, and if you'd like a copy of this, we'll be happy to provide it for you. But if you'd really like to know more about how these things work, how they're appropriate for you, if they are, and how they would fit together with a properly built assets under management or investment structure to provide you some support, a foundation that you can then build your investments on, might be a really excellent choice. So I'm going to leave it with this. Again, thank you for joining us. I hope that to see you guys really soon on one of our upcoming events. We have a big one coming up toward the end of November, and we have some other programs going on, and we really appreciate you guys. You know, we've grown tremendously. We're having the biggest year we've ever had, and since then, Steve and I have been partners, and quite honestly, we're really proud of that, and we want to really thank you, because a very large percentage of that is the fact that you guys share with your friends and neighbors and refer us out to other people, because that's the best compliment you could probably give us, and we really appreciate it.
Thank you very much, Mel. We appreciate the deal on the annuities, and I couldn't found a better article. No two are alike. And I think the biggest thing that I like to put, because I get people a lot of times that say, I hate annuities. And I say, I do too, what kind? And then they got to figure out that there's more than one kind. And then when you mention fixed indexed annuities, there's a lot of those out there that I don't care for either. And that's why I'm glad we got Mel and our team down at Impact that scours everything to give us the best deals that are currently going on with each one of our clients. So I think that's probably the most important thing. And as I said, I just hate it when I see somebody that got an income annuity and they really don't need income, or they thought they were getting protected growth and they got one with an income rider and it's not growing very much. So having the right tool for the right job is one of the things that I believe Mel put into my head, God, what now, 14 years ago, into my head. You got to have the right tool for the right job. A hammer will work, but if you need a screwdriver, it doesn't do very good. Screwdriver will work, but if you need a hammer, it'd be better. So thank you very much, Mel, for talking about the fixed index annuities, because I think it's a misunderstood thing. Mel's been doing some presentations around the facts about annuities. If you see one of those come up in the future, please jump to it, because I think there's a lot of misinformation out there about annuities. And I thought that was a very excellent presentation that Mel just did. So we'll go from there. Now let's talk about what nobody wants to talk about. What the heck is going on in the stock market? We've got the ups and downs of the market. The last 3 months have been the worst 3 months in a very long time. So we have to look at what's going on in the market. So we had a little bit today. The Federal Reserve made the decision that they were not going to increase interest rates at this meeting. Still a possibility for later in the year, but that's kind of been taken off the table. So we got a little pop in the market today. But we have to look at, and that's when a lot of people look at, what's going on in the market. I know I don't share a lot of screens, but I am going to share one today. And it's going to be one that talks about the market itself. We start to look at, and a lot of people, when they come in, they only want to talk about one thing, the NASDAQ, up almost 20%. This is through October the 23rd of 2023, 27th of 2023, up 20%. Why is my portfolio not up? Well, let's look what the Dow was down 2.2% year to date. Well, that's only 30 stocks, Steve. Yeah, I'll agree with that. But there's only 7 stocks that are currently driving the NASDAQ 100. Those 7 stocks are driving the S&P 500. We look down to the Russell 2000, smaller stocks, down almost 8%. Bonds, 15, 16, 14. Those are supposed to be the safe things, aren't they? So we look at the different things and we look at the overall market performance. Most people don't realize that back in December of 2021, that was the last time we hit a market high. So for almost 2 years now, the market is in a lower position than it was then. So we have to look at that and say, wow, it hasn't even capped those highs yet. And then we look at some of the high flyers of the NASDAQ that are up 75 to 80% in 2023. And they're still 50% of what they were at the height in 2021. So we have to look at what's going on. Where is it coming from? Then we look down at the sectors. We try to look at some of the sector analysis of the S&P 500, because it's not all in one place. Look where it's all coming from. Information technology, consumer distribution, staples down 10%, healthcare down 10%, financials down 8%, industrials 1.8%, communications up, utilities down. A lot of the things that were considered safe are down in the S&P 500. So that's why we look at it, folks, and say we need a well-diversified portfolio. Because I can tell you what, everybody says, why don't we have all of our money in information technology this year? It's up 31%. What was it down last year? It's like I said, a lot of those high flyers are still not back to where they were in 2021. So we have to look at that overall picture. And our goal is we put through it. And it was my decision when we decided to switch to Impact Partnership Wealth because of the relationship with Brad Jenkins and Market Guard. I want the best return I can get from my clients. I want it to be above average for less than average risk. Because I don't believe it fills anybody to say, yeah, I made 30% this year, but I lost 70% last year. And I'm still down 30 to 50% off of what my all-time high was. For most of our clients, avoiding large losses is the biggest thing that we need to do. You know, we have clients that can take the ups and downs. Why? Because markets are efficient. What do I mean by that? Well, if markets are efficient, when markets are up, what usually happens? The market corrects itself and it goes down. And when markets get too low, what usually happens? People will start buying again. So over time, the efficiency of markets works very well. It's when we get knee-jerk reactions and we pull in or we pull out. But that's what I love about the target portfolios that Brad has put together. If you haven't come in as a client to actually sit down and let us walk you through what the Market Guards have done, please make sure you come in and do that so we can get you reallocated into the Market Guard portfolios. Because I like that idea is I want as best return that I can get with the least amount of risk possible. We do have the availability with individual stocks, but that's usually for larger clients now. It's usually got a $75,000 to be totally, diverse and balanced in the portfolio. So it takes a little bit more money to be able to do that. But we have those availability. As has been talked about, we usually only had the yield structured notes. Now we have dual directional structured notes. We've got the availability for no loss in a structured note. So if you have not come in to talk to us about what's available with Market Guard, please set up that appointment. You're getting calls from Christina, you're getting calls from Chrissy to set up those appointments. Come in, sit down and talk with us. If you don't want to come in, we can do it by Zoom like we're doing right now. An allocation meeting to help explain Market Guard to our clients can be done in a half hour to 45 minutes. If I'm going to do a full review, give me my whole hour and 15 minutes, because I need all that time to be able to get it done. But if we're just going to talk about Market Guard, let's go from there. Because as we can see here, the entire market is not up. So we need to look at it. We want to be diversified because we don't want to only be in the class that's high. Because we look at those sector analysis charts, very seldom does an asset class repeat 2 or 3 times as the highest returning one. It's usually high, and then it drops down into the lowest sectors. So we got to be careful chasing returns. Careful chasing returns. And remember that the focus that we like to look at is where are we at in the long term. Let's avoid the noise, because I look at it today. It says markets are up, Feds decide to hold. Well, they were up about 1% today. So be careful with the headlines. If you've got questions or if you get nervous, please give us a call, because that's what we're here for. We're here to give our expertise on what we think is going on and what we believe is best for you, the client. Because if I have to move to a more conservative model, does not change your fee, does not change anything. I don't make any more money or any less money. We want to do what our clients want to do, but I also feel that our most important job is to help protect clients from themselves. But in the long run, whose money is it? It's yours. If you want to become more conservative, that's not a problem with me. So let's sit back and look. Again, I want to state that next Wednesday on November the 8th, I will be doing a presentation at the Lodge of the Pair on taxes in retirement. So if you know somebody that might be advantageous to bring to make that introduction, please feel free to do it. There's no cost. It's going to start at 6 o'clock. Again, that is on November the 8th at 6 o'clock at the Lodge of the Pair. taxes and retirement. We would like to know who's coming in, so we got enough chairs set up for the event. So if you or somebody you know would like to attend that event, please give the office a call, set up a reservation for yourself and a friend to come to that meeting. Again, I want to thank all you all. As Mel said, it's been a fantastic year. It's because of, doing business with family and friends. It's fun to do that. And who do I want to do business with? People just like you, our current clients. So again, thank you very much. We really appreciate the time. Please, if you got any questions or if you have a topic that you would like to hear about, please give us a call. We'll try to cover that in the next town hall. Thank you for attending.